Hello everyone. You can call me Resi. This is a new channel that I'm starting on YouTube. The goal of this channel is to foster critical thinking. Now, a little bit background about myself. I've been working in the quantitative modeling field in financial firms for almost 10 years. I hold advanced degrees in statistics and engineering. This channel will cover a wide range of topics, but initially, I plan to comment and critique valuable articles that I selected from well-known publishers such as the New York Times, the Wall Street Journal, and Bloomberg. In today's segment, I will be talking about one article from the New York Times. The first article is titled, "Yes, you can get free trading, but there is often a catch." So, in case you haven't noticed, in recent months, there has been a decreasing trend in the fees that's charged in brokerages such as Charles Schwab. In fact, Charles Schwab recently has announced that they would not charge a fee for their customers that trade for trading stock and ETF on their website. In this article, the New York Times journalist lay out two potential traps for this new observation. The first one is the New York Times journalist mentioned that these brokerages who have little to no trading fees oftentimes try to make up their shortfall, their revenue shortfall, by allocating a higher percentage of cash in your investment portfolio in the fund. Just to clarify that, I personally use one of these brokerages. So I actually have a AI managed fund that allocates a certain percentage of my portfolio in cash. So the journalist said that to recoup cost, company will choose to hold these cash in low yield accounts that pays interest at a rate significantly lower than you would otherwise be able to earn in a typical, say, money market account, which as it stands currently, you can earn it close to 2%. So, and that differential helps make up this fall by charging in fees. I personally don't think this observation is particularly bad or negative for retail investors such as us. For example, the most important reason I do not believe that this company that they are just trying to play a scheme and play a game that they lower the price on one end and increase the price on the other end. I think the big theme here is really that the competition in the online electronic trading arena is very severe. It's very fierce. Brokerages such as Charles Schwab, they want to get ahead. They want to gain a bigger market share by truly offering something that others couldn't match. And this approach, I think, is very similar to, say, Amazon. When Amazon, the reason why it's so successful is shipping. That you pay an annual fee, but you get unlimited. Now, free 1 day Prime shipping for a lot of products that you can buy from their website. So, and oftentimes the prices that you're able to buy from the website are the least, if not one of the lowest price you can find anywhere. So I don't particularly find this catch to be that negative for the investor, for investor and retail investors. So as of now, I wouldn't worry about it too much. Now, the second point that this journalist talk about is related to what's called payment for order flow. So in summary, so this basically is telling us that some of these smaller brokerages will sell the rights of executing these retail trades to large, sophisticated wholesale brokerages, and in return, they receive a fee. So what that means for retail customers like us is that the price per share, say if you're trading a stock, that you're able to get on these zero trading firms may not be as good as that you would be otherwise be able to get from other brokerages. So for example, if you're buying Microsoft stock, instead of getting a share of perhaps $150, you might have to pay $150.5 or $151 or something in that range. Now this is actually something that I think is a concern for retail investors like us, because you basically have no choice if you're using this brokerages. The price you pay is the price that they give you. So a potential way to mitigate that is to do some research yourself. And now there's a lot of other websites out there that you can check a real-time stock pricing. So what you can do is to do that, or before you decided to purchase stock on these brokerages, that you do a research, that you look at the range that is trading at market opening, so that you have an idea, that so you can be certain that you're not overpaying for the share. Hope this helps. So what you all think about this article, and do you think that this practice of lowering the trading fees is actually going to help retail investors like us or not? Please leave the comment, and I will try to respond to your comments as soon as possible. Thank you for your attention. If you like the video, please like and subscribe, and share it with your friends. Until next time, Resi out.